Warren Buffett sells half of his shares of Apple. The yen carry trade spooks the markets, and the Fed now has a tough decision to make in September or sooner. We're going to discuss this plus the problem with bull market complacency on this episode of Investment Insights from Opal Capital. Thanks for tuning into this episode. My name is Jay Coulter. Joining me as always, Adam Mueller and Austin Graff. Let's dig right in. Recently, Warren Buffett sold half of his stake in Apple. Adam, what does that tell you?
Look, it tells me very little. Timing is everything, right? I think that the issue and the reason it was even a big headline was, first of all, because it's Apple, which is, of course, a huge company and a company that everyone knows, but also that the disclosure happened to come out at the same time that there was significant market weakness. The market was already down. So Buffett selling half of his largest position spooked the market further, exacerbating the sell-off perhaps. But in reality, Berkshire still owns $80-something billion worth of Apple. It's an investment that has gone up 10 times since Buffett started buying it, had become a significant portion of Berkshire's overall market cap. And Buffett, the genius that he appears to be quite often, looked at the valuation and said, now is a great time to trim Apple. And he still has a huge position. So I think it was really just the fact that the disclosure came out when the market was, in free fall, which is just pure coincidence.
Austin, what's your take?
Yeah, I think it's interesting because obviously this decision was made far before when the disclosure came out, and there's another sale in there in Bank of America. And if you wanted to draw a conclusion from that, you could say that Buffett sees, the market falling and he's raising cash. But it's actually really hard to understand what's going on. There could be any number of scenarios that he's working through. And you shouldn't necessarily just do what Warren Buffett does. For those that don't remember, he sold out of many airlines in 2020, missing the recovery when many people thought that he was obviously right. He was not right. And it should just remind everyone that nobody has a crystal ball, even if their name is Warren Buffett. So just mindlessly following them down any path that they appear to be following due to dated filings is probably not a great strategy.
Yeah, let's talk about Warren Buffett himself. So maybe the greatest investor of all time, probably in the top 10. He's 93 years old. At what point does the market say, okay, maybe Warren has started to age out of this?
Look, I don't think he's gone full Biden yet. You know what I mean? And, people have been talking about that. People have been asking that question about Buffett for 15 years. And, the real question is, if there is any cognitive issue at some point, does he recognize it? Because he doesn't necessarily, or does he doesn't necessarily have Nancy Pelosi to whisper in his ear, time to step down, buddy. So look, it's something to watch for. But I don't think today, as of the last time I saw him speak publicly, he seemed very, very much with it and as sort of savvy as he ever has been.
Yeah, investing is one of those things you don't really age out of. You tend to get better with time. Obviously, there's going to be some point in which, there is some degradation there. It'll be unclear whether, I don't think any of us are going to know whether he's there or not for many years past when it actually happens. It's kind of like the economic cycle. You don't know if you're in a recession until you're already deep into the recession. And therefore, I think it's just, speculation, right? Like in the late 90s, everyone thought that Buffett was far past his prime. It now appears as though he was just kind of hitting stride in his career as he's multiplied his net worth many times since then. So I think it's hard to speculate, and I would prefer to focus on things that are maybe a little more relevant.
Look, I think the most amazing thing about Buffett, and to me why he's such a unicorn, is the passion that he has. I think there are very few people that accumulate the kind of wealth that he has and has had for decades that wouldn't have retired 20 years ago and be on a private island being fed grapes by former Hooters waitresses. This guy still wants to be an investor. To me, that's the most unique thing about him in his 90s.
He tried to retire like 50 years ago and didn't succeed. So I think he just loves to do it, and that's one of the great things about watching him and following him is the passion's still there.
If we could all be so lucky to live that long and still be passionate about what we do. Next topic. The markets have been spooked recently. Some thought is that it's part of the yen carry trade unwinding. Austin, I want to start with you, and can you explain at a basic level to investors what that means?
Yeah, I wish it was really simple, but basically what it comes down to, and trying to simplify it, is that interest rates are really low in Japan. So people are borrowing in the yen at very low rates and reinvesting in areas that they can achieve higher returns. And one of the areas that many people have achieved higher returns in the last few years has been in big cap US tech. And so what you saw as interest rates went up, or as the Bank of Japan increased interest rates in Japan, it all of a sudden caused a bunch of these people that had borrowed yen and bought big tech. It forced them to sell their big tech to pay back the yen, which created a pretty dramatic sell-off in the markets. It's been compared to some of the long-term capital management currency fluctuations back in the late 90s. I don't think it's clear at this time what actually happened or what the ultimate shakeout is going to be, but there's no shortage of people speculating on what's going on right now, which makes for an interesting news cycle.
Adam, what are your thoughts?
Look, it's interesting because if someone says, "Hey, I'm going to give you $100 and you don't just pay me the $100 back in the future, zero interest rate, and I could go buy a U.S. Treasury yielding 5%," I'm just feel like I'm making 5% on my money, with zero risk. Of course, the problem is that assumes that currencies don't change, that interest rates don't change, and a lot of people made a lot of money by using that interest rate arbitrage. But those things always end, and the real question is, how levered is it, and what's going to happen and where has that money gone in terms of what gets hit when it ultimately has to unwind? Because people are going to get spooked at some point, and then they're going to look back at how much money they've made over the last few years, and they're going to want to lock in those profits. And typically it all happens at once, and that's why you get that snowball falling down the hill effect, which we saw earlier this week.
And Adam, there's some thoughts that if the Fed were to step in here in the U.S. due to recent market turmoil and start lowering rates, that could impact the yen carry trade and exacerbate the situation. What do investors need to know about that dynamic?
Well, look, I think about it very simplistically, which is, if U.S. rates go down, all else being equal, investing in the U.S. is less profitable, and that has a currency effect where the U.S. dollar comes down, which means the U.S. dollar buys less yen, which means it's more expensive to pay back the money that you've borrowed in yen. But I do think this notion, one not great job print led to this sell-off and all these headlines from these talking heads on cable TV talking about, is the Fed going to do an intermeeting rate cut? Of course they're not, you morons. Like, it's a great headline. It's clickbait. It's nothing. It's fake news. It's amazing that people that want to be known as respectable business journalists would suggest that, not even one data point, and the Fed's just going to all of a sudden completely change course and do a sort of, and not an unprecedented, but a like emergency move. No, they're on pace to cut in September, and the real question is the cut going to be 25 or 50, or is more data going to come out that will change what that could be? But this idea that Fed's going to panic, have an emergency meeting, and Neil Kashkari is going to say, let's cut rates. It's not going to happen.
Yeah. Listen, if you're managing your portfolio based on speculation of the yen carry trade or what the Fed's going to do next week, you're doing it wrong, right? Like, if you want to avoid the impact of the yen carry trade on your portfolio, how about you look at fundamentals and buy something that makes sense based on the fundamentals, not based on what the Bank of Japan is going to decide to do with interest rates or what Neil Kashkari is going to influence Jerome Powell to do with interest rates in the US. It's impossible for people to understand what's going on in these people's heads. So a much more simple or a much more straightforward approach would be just to focus on fundamentals. It's not that complicated.
Right, because they talk about like how much aggregate market cap was lost in the sell-off, and it's a huge number, and it's staggering, and you're like, wow. But how many people sold at the bottom because they panicked and missed this 2-day bounce? And what's the amount of money that those people who are probably large, maybe there's some professional investors and also just regular people making day trades in their Schwab accounts that just lost a considerable sum of money because they saw headlines on the news and, Buffett's selling Apple, Fed might have an emergency cut. The world's falling apart. The world fell apart for it was 3 days. The S&P was down less than 10%, which, by the way, a 10% drawdown over the course of time happens almost every year, and yet the sports center of the stock market, CNBC, fuels the panic.
Schwab, Fidelity, and Vanguard all were down on Monday morning, and you just wonder how much money that saved people because they couldn't do what they wanted to do, which is most likely sell in the down market.
It's like missing your flight to Vegas. It saves you money in the long run.
Let's use that to dive into the next topic, and that's Fed rate cuts. Have your thoughts changed on what the Fed is going to do at the next meeting and how they approach the rest of the year? Austin, why don't you go first?
I don't think our thoughts have changed much, but the market thoughts have definitely changed, which shows you how kind of emotion just ricochets through the markets, right? Before we had a couple of weak economic data points, less than 2 weeks ago, the expectation for a greater than 25 basis point cut in September was almost zero. And all of a sudden, we have a relatively weak jobs number. We have a carry trade situation with the yen. We have markets selling off. And now the market expectation is that there's a greater than 60, in some places, 90% chance that there's a 50 basis point cut in September. Now, when we see these things, we go back to what the Fed says and we say, what's the data telling us? And the data isn't telling us that there's a 90% chance of a 50 basis point cut in September. Now, the data could continue to get weaker, but in reality, all we've seen is 1 or 2 data points that point to a slowing in the economy, nothing falling off the cliff. We wouldn't expect the current data points that indicate that a 50 basis point cut is needed. However, that's not stopping the talking heads from coming out and speculating and kind of seeding more fear in the market.
Yeah, Adam, what's your take?
My take is that someone should launch a business news cable channel where they're not allowed to talk about the Fed, where they talk about companies and company earnings and really dig into those issues, because it's just taking up so much airtime. And 25, 50 bips, that in and of itself doesn't actually matter, I don't think. I think what matters is if they cut 25, 50 bips and then what they say about the future. What matters is if the rate ends up going down 2-3% over the next 12 to 18 months. That's what matters, not what this first cut is. And the reality is 18 months is a long time from now. And a lot of data is going to come out along that journey. And all these talking heads that want to tweak their probabilities, because unless they say 0% or 100%, they can't be wrong. Always remember that when someone gives you a probability, they have an easy out when they're wrong. If it doesn't go in the way they actually think it could go.
Next topic. Let's discuss bull market complacency. So I'm old enough to have lived through the internet bubble, which had a massive spike in euphoria, but there was complacency for a long time. And then before the great financial crisis, there was definitely euphoria in real estate, complacency in the equity markets. And then really for the last 15 years, with the exception of the COVID drawdown and the drawdown in 22, there really hasn't been a bear market. How should investors be thinking about this bull market complacency? Austin, why don't you go first?
I think that after you've had a long run in markets, we tend to find a lot of people are complacent, expecting that the most recent experience is going to be extrapolated indefinitely into the future. That's not necessarily the way things work. While it is tempting to want to jump on, and this kind of gets to the lemming trade, where everyone wants to do the same thing and eventually they all run off the cliff and die. This happens a lot with investors where they don't die, but they significantly encumber their portfolio because they all chase the most recent exciting thing and they become complacent to the risks that could be embedded in that new exciting thing. And so right now, if you look at some of the indices, you can see some complacency there where you see a handful of names representing, a third or more of the index. A lot of people like to say like diversification is the only free lunch, and so you should buy the S&P 500. Well, newsflash right now, if you buy the S&P 500, you're not all that diversified because you own an overwhelming majority of a handful of names. And so I think that investors need to step back for a second and start thinking about what's actually going on in the market rather than getting all excited by the emotion that is just ricocheting back and forth with cable news and FinTwit or FinX, whatever you call it today. That's exciting, I would say tremendously positive emotions. And then the last couple of days, negative emotions. Instead of letting those emotions dictate your decision-making, just focus on the facts.
Adam?
Yeah, look, I think it's really easy when there's not a cloud in the sky to assume that it's never going to rain again. And then you go out and you leave home and you don't take an umbrella. And guess what? At some point it will rain again. But people forget that. And it's a recency bias. It's you feel good because your investments have been doing well. And you sort of forget that there's this other direction things can go in. And it tends to happen quickly, right? Markets tend to kind of crawl upwards and then fall off a cliff to the downside, like a 10% drawdown in 3 trading days. I remember back in August 2011, I think it was, in something like 6 or 7 trading days, the S&P was down 20% with the European sovereign debt crisis and the U.S. getting down, credit getting downgraded. And those things happen from time to time. The irony is when there's not a cloud in the sky, insurance is the cheapest it's going to be. If you wait for it to start to rain and then you go try to buy, protection, it's like buying the condom after you've had sex. It's not going to help.
You got to take that out, Ken. All right, our next topic really dovetails into what we were just talking about, and that's looking at the VIX. Adam, I know you're not a big fan of the measurement tool, but it spiked over 60 this week with the recent market volatility. What does the VIX mean for investors?
I think the VIX spiking means the market went down. Like to me, it's very redundant with just looking at, okay, the S&P is down 10%, the VIX is up. That's just the relationship those numbers are going to have. But it does suggest that, what people sort of refer to it sometimes as like a panic indicator. It suggests that people are out there. There's demand for options to protect portfolios, and options have become more expensive because there's more volatility. Other than that, I think it's sort of notable. I think it's very tricky to try to trade volatility. But look, if you own some puts before the drawdown, the VIX spiking, that's how that really helps that insurance, rise in value, which is why you own it. So to me, it's sort of a function of options pricing, highly correlated to what the market's actually doing. And just, another data point amongst the sea of data points that suggests, yeah, wow, people started to panic a bit. There was a drawdown.
Austin, what's your take?
I think it's interesting that people try to use the VIX as a way to managing risk in their portfolio, because in reality, the VIX spiked, I think it went to 82 for a few minutes, and then it dropped back to 60. And then a couple of days beyond, it's much lower. It's getting back to historical norms. How many people actually sold those options at 82, right? How many people actually capitalized on that change? Because I guarantee most of the folks that have been sitting on these options were like, oh, it's at 82 going to 200, right? They're still holding the bag on this thing, and they're riding it back down the other side. So it really didn't do a whole lot for their portfolio other than make them feel good for a day when equities were down and their holding and options were up. So I think it's an interesting indicator. It's an interesting thing to watch and for people to talk about on TV. I just don't know how relevant it is for portfolios unless you're to put, a small portion of your portfolio in a tail risk hedge product that's going to generate a massive return when everything else is getting crushed, and you're hoping that there's, some crushing thing that comes and hits the market at some point.
Look, one of the hardest parts about having a hedge is when it actually starts to work. And you have that moment of if things bounce back, then the value of that hedge comes off. If I sell it and the market goes down another percent, I feel sort of silly because I've thought the fire was going out, so I sort of got rid of my insurance, stopped paying my insurance premiums, and then the fire picks back up again. The reality is, I think the best way to hedge a portfolio is to think of it as insurance that should go to zero and manage it that way. Think of it as a sunk cost, so that way you're not sort of in agony trying to decide whether or not you unwind the hedge.
Yeah. Well said, Adam. Insurance should go to zero. You don't want to use your homeowner's insurance or your car insurance.
Right. Like if you're trading volatility using options, then you should have been smart enough to sell when VIX spiked. If you were buying insurance for your portfolio, you should be saying, I'm gonna put 2% of my portfolio into insurance, and then over the year that's going to go to zero, and then you just keep it.
Final topic: shares of Airbnb plunged this week. Austin, what's that telling us about the economy?
I think a big reason for the plunge is just forward guidance, and it's showing that there's more weakness in the services sector than was originally anticipated at the beginning of the year. A lot of companies are expecting back-end growth for 2024, meaning that the growth was slow in the first half and the back half was supposed to be much more aggressive. When we see the S&P sitting at 11, 12% expected growth for the year, a lot of that's sitting in back-end weighted growth for companies. As we saw Airbnb, the back end might not be as good as people expected. So you're seeing the stock price come down pretty dramatically. Some of that might be because of consumers. Some of that might be because people are just tired of traveling. But for whatever reason, they're not expecting as rosy of a future as they did last quarter.
Adam?
Look, I think as a famous growth investor once said, when you're a growth story, you've got to grow. So when those numbers don't meet expectations, the stock's going to sell off. Look, I think it's a tricky thing to make a big read through to the U.S. consumer. I think some people are just migrating back to hotels. I think there have been some problems, it's hard to tell how often, but it gets a lot of publicity when an Airbnb owner puts a little secret camera in the Airbnb and starts filming people. And there's been problems with that, and that people start shying away. People start going back to the Marriott when that happens. So I think it's a little tricky, but it's also a bit of a fad in that it was a really interesting alternative, very interesting use of technology when it first appeared. People took advantage of it. There's people who are running businesses by just buying a bunch of units and using Airbnb. And now we've also got cities and areas that are making them illegal. So there's a lot of moving pieces in the story. I think a straight read through to weakness in the U.S. consumer, I think that's a little misguided. I'd rather look at I'd rather look at the bank's credit card charge-offs than look at Airbnb.
Gentlemen, that's a wrap for this episode. Viewers and listeners, if you'd like to learn more about Opal Capital, please visit opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.